Picture this. It's 4:47 in the morning on January 3rd, 2026. While most Americans are sleeping off New Year's celebrations, U.S. Special Operations Forces are executing a pre-dawn raid that will fundamentally alter the global energy landscape. Within 140 minutes, Venezuelan President Nicolas Maduro is in American custody. The official story? Counter-narcotics, drug trafficking, organized crime networks. The standard explanations we've heard countless times before. But then President Trump says something that should make every American stop scrolling and pay attention. We're going to take back Venezuela's oil. Not stabilize, not secure, not liberate, take back. Those two words raise an obvious question. Take it back from whom exactly? Let me show you what's really happening here. Because the evening news isn't connecting the dots that matter most to your financial future. Venezuela controls 303 billion barrels of proven oil reserves. Not estimated, not theoretically recoverable. Proven, certified, drillable. Let me give you some context that makes this number hit differently. Saudi Arabia, the name synonymous with oil power, holds 268 billion barrels. Russia has 80 billion. The entire United States sits on 68 billion barrels of proven reserves. Venezuela has more oil underneath its soil than the next three OPEC heavyweights combined. Think of it this way. If the world's oil supply were a deck of cards, Venezuela is holding roughly 1/5 of every card in the deck. That's not a minor player. That's a kingmaker, or at least it should be. So here's the puzzle. We've known about Venezuela's massive oil wealth for decades. The reserves didn't appear overnight. The geology hasn't changed. Why did American forces conduct this operation in January 2026 specifically? That question leads us down a path that reveals something far more consequential than regime change or drug enforcement. It exposes a financial architecture that has been systematically dismantling the foundation of American economic dominance for nearly 2 decades. And most Americans have no idea it's even happening. Starting in 2007, something historically unprecedented began unfolding between Caracas and Beijing. China's State Development Bank started extending enormous loans to Venezuela. We're talking about $60 billion flowing across the Pacific over an 8-year period. But these weren't your grandfather's international loans. No quarterly reports to the IMF. No interest payments wired through New York banks. No dollar transactions at all. Venezuela and China engineered something entirely different. A loans for oil mechanism that should concern anyone who understands how American prosperity actually functions. Here's how it works in practice. Instead of Venezuela writing checks in dollars to repay Chinese loans, they load physical barrels of crude oil onto tankers. Those tankers sail to Chinese refineries. The oil gets unloaded, refined, consumed. The debt gets serviced through commodity transfer rather than currency exchange. The critical detail? These barrels never touch international oil markets. The transactions never clear through dollar-based banking systems. No American financial institution processes these deals, monitors these payments, or extracts any fee from the transaction flow. According to recent South China Morning Post reporting, Venezuela still owes China somewhere between $17 and $19 billion as of January 2026. But the repayment method completely bypasses the financial plumbing that American economic power is built on. By November 2025, just 2 months before U.S. forces landed in Caracas, roughly 80% of Venezuelan oil production was flowing to China. We're looking at 778,000 barrels per day moving across the Pacific, all compensated through yuan payments or direct barter arrangements that deliberately avoid the dollar system. Now, let me explain why this matters to you personally, even if you've never thought about international currency markets in your life. Every time you pump gas into your car, every time you hear about oil price movements on the news, every time OPEC makes production decisions, there's a fundamental assumption embedded in the entire system. Oil trades in US dollars, period. This arrangement, economists call it the Petrodollar system, traces back to 1974 when Nixon and Kissinger cut a deal with Saudi Arabia. The Saudis would sell their oil exclusively in dollars. In exchange, America would provide military protection and purchase Saudi government bonds. That handshake created an extraordinary privilege for the United States. Think of it like this. Imagine you're the only person in your neighborhood who can sell water. Everyone needs water daily. That means everyone needs to constantly do business with you using your terms through your payment system. You become indispensable, not because you provide the best service, but because you control access to something nobody can live without. That's what the petrodollar system did for America. Countries around the world needed dollars to buy oil, which meant they needed to hold dollars as reserves, which meant they bought U.S. Treasury bonds, which meant America could borrow money at incredibly low interest rates for 5 decades straight. Your mortgage rate? Lower because of the petrodollar. Your car loan? More affordable because of the petrodollar. America's ability to run trillion-dollar deficits without economic collapse? Entirely dependent on the petrodollar. Venezuela and China weren't just signing a bilateral trade agreement. They were constructing a functional alternative to the monetary architecture that has allowed America to borrow cheaply while living beyond its means for half a century. And they weren't hiding it. The tension had been escalating for months before anyone deployed military assets. December 10th, 2025. U.S. forces seized the MT Skipper, an oil tanker carrying Venezuelan crude. December 20th, another vessel, the Centuries, gets intercepted. Same cargo, same destination, China. December 22nd, American naval forces pursue a third tanker, the Bella 1, attempting to deliver Venezuelan oil to Chinese buyers. When reporters pressed Trump about these seized tankers, his response was remarkably direct. The United States would keep the oil. Not return it through diplomatic channels, not auction it through legal proceedings. Keep it. That statement represents the first time since the 1970s that American military forces have directly confiscated crude oil shipments on the high seas, specifically to enforce dollar supremacy in energy markets. Let me translate what this means for your financial security. You know how your retirement account depends on stable Treasury bond yields, how your pension fund's returns rely on a strong dollar, how your kids' college savings grow based on predictable market conditions. All of that stability exists because countries need dollars to function in the global economy. They need dollars to buy oil. They need dollars to settle debts. They need dollars to hold as reserves. This creates perpetual demand for our currency, which keeps interest rates artificially lower than they'd otherwise be, which makes everything from government borrowing to consumer credit more affordable across the entire economy. Venezuela's system with China threatens that entire mechanism. When major oil exporters can sell production in yuan, when they can finance infrastructure through Chinese loans repaid in crude oil, when they can operate entire economic sectors outside dollar-based clearing systems, it breaks the fundamental dynamic that has supported American living standards for 2 generations. TD Securities, one of North America's largest financial research firms, published analysis on January 5th, 2026, explicitly stating that the Venezuela intervention wasn't primarily about removing Maduro or fighting cartels. The operation aims to bring Venezuelan oil production back under dollar-denominated trade systems. That's not conspiracy theory. That's institutional financial analysis from major market participants. Consider the timeline carefully. We watched Venezuela's economy implode under sanctions for years. We documented currency hyperinflation. We saw humanitarian crises unfold. We observed refugee flows, political chaos, social breakdown. Through all of that, through every sanction package, every diplomatic condemnation, every international pressure campaign, we didn't send the military to seize control. The operation happened precisely when Venezuela's non-dollar oil trade with China reached critical mass, when 80% of their production had successfully redirected outside the petrodollar system. The Council on Foreign Relations released assessment on January 8th, acknowledging that actually increasing Venezuela's oil output under new management will take years, meaning this operation was not about quickly flooding markets with cheap crude to lower your gas prices next month. It's about reasserting control over who gets to sell oil outside the dollar framework and under what terms. Think of it like a shopkeeper who suddenly realizes customers are trading goods in the back alley instead of coming through his front door. The shopkeeper doesn't care about the specific items being traded. He cares that transactions are happening outside his view, outside his control, without him taking his customary cut. Let's talk specifics, because the details reveal just how sophisticated and deliberate this challenge to dollar dominance really was. This wasn't some desperate arrangement thrown together during a crisis. China's State Development Bank began extending these loans to Venezuela back in 2007, when oil prices were climbing toward pre-financial crisis peaks, and Venezuela's socialist government was flush with petroleum revenue. Between 2007 and 2015, China channeled $60 billion into Venezuela through structured financing that looked nothing like traditional international lending. These weren't IMF-style structural adjustment loans demanding privatization and fiscal austerity. China funded tangible infrastructure projects in exchange for guaranteed oil deliveries, stretching decades into the future. The money built the Tinaco-Anaco Railway connecting Venezuela's industrial heartland. It launched the Simón Bolívar satellite into orbit, providing Venezuela independent telecommunications capability. It constructed power plants, housing developments, agricultural facilities across the country. Every project came with Chinese contractors, Chinese equipment, and repayment terms denominated in barrels of crude oil rather than yuan or dollars. Think about the strategic brilliance here. China isn't just lending money and hoping for repayment. They're building physical infrastructure that increases Venezuela's production capacity, which increases the volume of oil flowing to Chinese refineries, which services the debt automatically through commodity transfer rather than currency exchange. It's a self-reinforcing cycle that becomes more entrenched with every barrel that moves from Venezuelan wells to Chinese refineries. According to energy market data, Venezuela was exporting 952,000 barrels of crude oil per day by 2025. Of that total daily production, 778,000 barrels, roughly 82%, went directly to China. That's not a side arrangement. That is the overwhelming majority of a major oil exporter, is production completely bypassing the monetary system American prosperity depends on. You might be wondering, how did Venezuela keep this oil flowing despite years of U.S. home sanctions designed specifically to choke off their exports? This is where the logistics network gets genuinely concerning for anyone who understands how financial surveillance operates in the modern economy. Venezuelan oil doesn't travel to China through major international shipping companies that answer to Western regulators. It moves through what industry analysts call dark fleets, a combination of Chinese, Iranian, and Russian logistics firms that operate entirely outside traditional maritime insurance and banking systems. These vessels don't register with major flag states. They don't insure through London-based syndicates. They don't finance operations through New York or European banks. When the oil arrives in China, it doesn't get processed by the major state-owned refineries that international media typically covers. Instead, most Venezuelan crude flows to what Chinese industry insiders call teapot refiners, small independent refineries clustered in Shandong province that operate with far less scrutiny than the massive coastal petrochemical complexes. These facilities process millions of barrels of sanctioned oil from Venezuela, Iran, and Russia, while remaining largely invisible to Western financial surveillance systems. Think about the strategic implications. China built a complete end-to-end supply chain for crude oil that functions without touching any of the choke points where America traditionally exercises financial control. No dollar clearing, no SWIFT messaging, no Western insurance, no international banking oversight. It's a parallel commercial universe specifically designed to be sanction-proof. Here's where we need to examine precedent, because Venezuela isn't the first major oil producer that tried escaping the petrodollar system. And when you line up the timeline, the pattern becomes impossible to dismiss as coincidence. Iraq, 2000. Saddam Hussein announces Iraq will begin accepting euros instead of dollars for oil sales. This wasn't symbolic. Iraq was a major OPEC producer, and the switch to euro-denominated sales represented the first serious challenge to petrodollar hegemony since 1974. What happened next? The United States invaded Iraq in March 2003, barely 3 years after Hussein's currency switch. Libya, 2011. Muammar Gaddafi proposes creating a pan-African currency called the gold dinar. He advocates for African and Muslim nations to conduct oil sales in this new gold-backed currency rather than dollars or euros. Gaddafi had resources to make this credible. Libya held Africa's largest proven oil reserves and substantial gold stockpiles. NATO launches military intervention in Libya in March 2011. The same year, Gaddafi intensifies his gold dinar advocacy. Within 8 months, Gaddafi is dead and Libya's gold reserves mysteriously vanish. Venezuela, 2026. The pattern repeats with remarkable precision. A major oil producer constructs a system to sell crude outside the dollar framework. The challenge reaches critical mass. In Venezuela's case, 80% of production flowing to China through non-dollar channels by late 2025. Within months, regime change arrives with military force. Are we really supposed to believe this is coincidence? 3 separate oil producers, 3 separate attempts to bypass dollar hegemony in energy markets, 3 military interventions within 3 years of their currency, alternatives reaching operational scale. The difference with Venezuela is the magnitude of the alternative system. Saddam's euro experiment affected a sanctioned nation with limited export capacity. Gaddafi's gold dinar remained mostly theoretical, discussed in meetings but never fully implemented. Venezuela's arrangement with China is operational, it's massive, it's backed by the world's second largest economy. We're talking about nearly 800,000 barrels per day moving through established supply chains, processed by functioning refineries, financing real debt obligations, all outside dollar systems. China didn't build this network carelessly. Beijing structured these deals to create strategic interdependency running both directions. Venezuela needs Chinese financing and market access to survive international sanctions. China needs guaranteed oil supplies outside Middle Eastern networks where American naval power can interdict shipments during any future crisis over Taiwan or the South China Sea. The system creates what military strategists call strategic depth. If tensions escalate between Washington and Beijing, if the U.S. attempts sanctioning Chinese oil imports, if conflict disrupts traditional supply routes through the Strait of Hormuz or Malacca Strait, China has alternative crude flowing from Venezuela through Pacific routes that bypass American choke points entirely. That strategic independence, the ability to access energy without permission from dollar-based financial gatekeepers, represents exactly the kind of threat that triggers enforcement operations. Let's talk mathematics, because the data tells a story no amount of political rhetoric can obscure. According to the International Monetary Fund's official COFR data for Q2 2025, the US dollar's share of global foreign exchange reserves fell to 56.32%. That might not sound catastrophic until you understand what it represents. In Q1 2025, just 3 months earlier, the dollar held 57.79% of global reserves. We lost nearly 1.5 percentage points of global reserve share in 90 days. More critically, the 56.32% figure represents the lowest dollar reserve share since 1994, more than 30 years ago. We are watching accelerating erosion of the fundamental privilege that allowed America to borrow trillions at minimal cost for half a century. But here's the detail that should make every American pay attention, regardless of politics. Approximately 80% of global oil trade still settles in US dollars. Read that again. Our dollar represents only 56% of global reserves, but still denominates 80% of oil transactions. That gap between reserve share and oil trade dominance, that's the last structural pillar holding up dollar hegemony. Everything else is already diversifying. Countries are settling bilateral trade in local currencies. Central banks are buying gold at record pace. Alternative payment systems like China's CIPS are processing trillions in cross-border transactions. The IMF's special drawing rights are gaining traction for international settlements. But oil, the commodity every country needs, every economy runs on, that powers everything from transportation to manufacturing, still overwhelmingly trades in our currency. When Venezuela redirected 80% of its production to China through non-dollar channels, it didn't just threaten one bilateral relationship. It demonstrated that the last remaining pillar of dollar dominance can be circumvented at scale. And that's why aircraft carriers got deployed in January 2026. Meanwhile, China has been preparing for exactly this moment with remarkable patience. According to official Chinese data, Beijing's foreign exchange reserves reached $3.339 trillion by late 2025, the highest level since 2015. You don't accumulate $3.3 trillion in foreign reserves while simultaneously stacking 2,300 tons of gold, unless you're preparing for fundamental shifts in the international monetary system. China is positioning itself to weather precisely the kind of dollar instability that Venezuela's seizure represents. Beijing holds enough reserves to defend the yuan, enough gold to back alternative payment systems, and enough economic weight, 40% of global GDP when including BRICS nations, to create viable alternatives to dollar-based trade. The Venezuela situation forces China's hand in ways that should concern American policymakers far more than it apparently does. Beijing has $17 to $19 billion in outstanding loans to Venezuela, all supposed to be repaid through oil deliveries. When U.S. military forces seized control of Venezuelan oil infrastructure, it didn't just remove Maduro from power. It potentially confiscated Chinese debt collateral worth billions. China now faces a binary choice. Option A, accept the loss, acknowledge American military dominance over global oil flows, and continue participating in a petrodollar system where Washington can unilaterally nullify Chinese investments through regime change. Option B, accelerate development of alternative payment systems, deepen loans for oil programs with other producers like Russia and Iran, and demonstrate to the entire developing world that Chinese financing offers protection from Western financial coercion that American markets clearly don't provide. Which option do you think they'll choose? If you're a major oil producer watching the Venezuela operation unfold, what lesson do you draw? That selling to American markets in dollars keeps you safe? Venezuela had the world's largest proven reserves and still got invaded. Or do you conclude that diversifying your customer base, accepting yuan or rubles or gold, and building relationships with powers that won't seize your government when your monetary choices threaten their hegemony might offer more genuine security? The bond markets already understand what's happening, even if the evening news hasn't caught up. Foreign ownership of U.S. Treasury securities peaked around 50% back in 2008, right after the financial crisis when the world still viewed dollar-denominated debt as the ultimate safe haven. By early 2025, foreign ownership had collapsed to roughly 30% of outstanding treasuries. That's not a minor decline. That's a structural shift in how the world views American debt. Think of it this way. When foreigners owned half our bonds, we could run massive deficits with minimal consequence because global demand kept yields low. The world was essentially giving us cheap loans automatically because they needed our currency for oil transactions. When foreigners own only 30%, our government competes for capital with every other borrower in the world, and interest costs become a real constraint rather than a theoretical concern. Your mortgage rate, your car loan, your credit card interest, all of it ultimately traces back to Treasury yields. When the world stops automatically buying our government bonds, when the petrodollar system no longer forces countries to recycle oil revenue through New York banks, those baseline interest rates move higher, not catastrophically overnight, but persistently, structurally, in ways that compound over years and decades. The Venezuela operation represents desperation, not strength. When Nixon and Kissinger created the petrodollar arrangement with Saudi Arabia in 1974, they didn't need aircraft carriers to enforce it. The system sold itself. Countries wanted to hold dollars because America had the deepest capital markets, the most stable institutions, the most liquid currency. The petrodollar emerged from mutual benefit, not military coercion. 52 years later, we're seizing tankers on the high seas and conducting regime change operations to prevent countries from selling oil in alternative currencies. That transition, from voluntary participation to forced compliance, tells you everything about the system's trajectory. Strong mechanisms don't require military enforcement. They attract users through superior performance. Think about it like a restaurant that used to be the only good option in town. People came willingly because the food was excellent and the prices were fair. But now competition has emerged, offering similar quality at better prices. Instead of improving their menu or service, the original restaurants start sending bouncers to physically drag customers back inside and prevent them from eating elsewhere. That's not a sign of strength. That's a sign the business model is failing. The math here is straightforward, even if the implications are uncomfortable. You can't run trillion-dollar deficits indefinitely if the world is not forced to buy your bonds to purchase oil. You can't maintain reserve currency status when your share of global reserves hits 30-year lows while your enforcement mechanisms require aircraft carrier deployments. You can't preserve petrodollar hegemony when major producers successfully demonstrate that alternative systems work at massive scale. For decades, the petrodollar system allowed America to print money while other countries labored to earn it. We exported inflation through dollars, imported goods through debt, and maintained our standard of living through what French President Valéry Giscard d'Estaing called the exorbitant privilege of reserve currency status. That privilege is ending, not through conspiracy or malice, but through simple mathematics and strategic adaptation by countries that no longer benefit from the arrangement. Here's what should give Americans genuine pause. If the only way to maintain the system is through military force against countries representing an ever larger share of global resources and production, how sustainable is that strategy really? How many Venezuelas can we occupy? How many tankers can we seize? How many regime change operations can we execute before the cost of enforcement exceeds the benefit of hegemony? The dollar will remain important, probably dominant, for years or decades to come. That's not the question. The question is whether we're prepared for a world where our currency is one among several viable alternatives rather than the only option for international settlement, where our bonds compete on their actual merits rather than being automatically purchased because countries need dollars for oil, where our deficits carry real consequences rather than being financed through forced global participation in our monetary system. Let me bring this home to practical reality. The Venezuela operation on January 3, 2026, marked the moment when the petrodollar system openly transitioned from voluntary coordination to military enforcement. When historians write about the end of American financial hegemony, and they will, they'll point to aircraft carriers protecting currency dominance as the clearest signal that the foundation had already cracked. What happens next depends on choices we make as a country. Path A. We can acknowledge the mathematics, adapt fiscal policy to a world where deficits carry real costs, and build an economy that thrives through productivity rather than monetary privilege. Path B. We can keep deploying aircraft carriers to enforce participation in a system that countries are increasingly motivated to escape, watching the enforcement costs mount while the benefits steadily erode. The numbers don't lie, the pattern doesn't hide, and the foundation of American prosperity is changing whether we choose to acknowledge it or not. Understanding this reality, really understanding it, not just skimming headlines, gives you the power to prepare, to adapt, and to navigate whatever comes next. That's not pessimism, that's awareness. And in times like these, awareness might be the most valuable asset any of us can hold. The Venezuela operation isn't just about one country or one leader. It's about a 52-year-old system reaching the limits of voluntary participation and crossing into territory where only military force can maintain compliance. That crossing point tells us more about where we're headed than any economic forecast or policy statement ever could.